I want to start today with a very specific type of headline. You see it every few months, and it always stops me in my tracks.
Oh, I think I know exactly what you're talking about.
Yeah, it's the story of the brilliant trader or the tech visionary or even, the lottery winner who amasses this absolute fortune. I'm talking generational, life-changing wealth.
Yeah.
And then in a timeline that just seems impossible, it's gone. Poof. Zero.
Right. It's the modern Icarus story. We are completely obsessed with it.
We are. But I really think we look at it the wrong way. We usually just judge them, right? We think, oh, they got greedy or they were reckless. But looking at the research we have for today's deep dive, specifically the work from Morgan Housel and the Collaborative Fund, that judgment just misses the point entirely.
It really does. Because the mystery isn't why they were reckless.
Exactly. The real mystery is, if you were smart enough to make $20 million, why aren't you smart enough to keep it?
That is the core question. And the answer the data gives us is actually quite unsettling. It suggests that getting rich and staying rich aren't just different steps in the same financial journey. They're completely different skills.
Completely different.
Yeah. In fact, they require practically opposite personalities.
Opposite. So you're saying the traits that get you to the top are the exact same traits that basically push you off the ledge.
Precisely. This is what we're calling the survival paradox today. To make money, you have to be one type of person. To keep money, you have to effectively become someone else entirely. And very, very few people can actually flip that switch.
And that's our mission today. We're going to break down this paradox for you. We're pulling from Morgan Housel's concepts, some excellent YouTube analysis, and various financial psychology blogs to look at why survival is actually a much harder skill than brilliance.
It really is the ultimate test.
And most importantly, we're going to look at the specific hard constraints you can put in place to make sure you don't blow up. Because the default setting for a successful brain is actually self-destruction.
It's hardwired into us. Once you win, your brain works against you.
Okay, so let's unpack this. We have this idea of two completely different skill sets. Let's start with the fun one, the getting rich persona. When we look at the founders or the big traders in our sources, what is the psychological fuel there?
It's almost entirely fueled by optimism. And I don't mean just a, have a nice day kind of optimism. I mean a borderline delusional belief that the future will be better than the present, and that you specifically are the one to make it so.
Right. You kind of have to ignore the odds.
You have to. If you looked at the actual failure rate of startups or the likelihood of beating the market over a decade, you'd never get out of bed.
Seriously.
To get rich, you have to take aggressive risks. You have to be willing to put yourself out there. As the sources highlight, you have to be willing to look stupid for a while. You really can't play it safe and expect outsized returns.
It's about swinging for the fences.
Yeah.
You usually get rich by concentrating your efforts, putting all your eggs in one basket, whether that's a specific career path, a startup business, or a heavily concentrated asset class.
Yes. It's a game of offense. You are attacking the market, you're attacking the problem. It requires extreme confidence, speed, and a singular focus on the upside. You are leaning forward, constantly asking, what can go right?
Okay, so that's the engine. That's how you get the rocket into space. You're optimistic, you're aggressive, and you're highly concentrated. Now, let's say you hit your number. You've made it. Logic dictates you should just chill out and protect it. Why is that transition so incredibly hard?
Because the staying rich persona is the polar opposite. If getting rich is about optimism and risk, staying rich is about humility and, frankly, paranoia.
Paranoia. That sounds a bit extreme.
Well, a healthy paranoia, a constant fear that what you have built can disappear just as quickly as it arrived. It requires extreme frugality and a massive shift from swinging for the fences to just making sure you stay in the game.
So you stop looking for the big win.
Right. You stop asking what can go right, and you start obsessing over what can go wrong.
Wow. So you have to switch from being a relentless optimist to a defensive pessimist the exact moment you see a big number in your bank account.
In a way, yes. And that is the massive conflict. That is exactly why so many people blow up. The sources describe this perfectly. Blow-ups happen because people try to use the getting rich playbook forever.
They just can't turn it off.
They keep swinging for the fences even after they've already won the game.
It's like a football team that's up by 4 touchdowns in the fourth quarter, but they're still throwing risky Hail Mary passes instead of just running out the clock.
Exactly. And then they get intercepted and lose the game. The skill set that got them the lead, which is that aggression, is the exact thing that cost them the win.
Yeah, that makes so much sense. So let's talk about the psychology here, because on paper, it obviously makes sense to switch gears, but in practice, Our brains fight us on this.
Mm.
Why is success such a dangerous teacher?
There is a fantastic quote from Bill Gates in the source material that sums this up beautifully. He said, "Success is a lousy teacher. It seduces smart people into thinking they can't lose."
It seduces smart people. That is scary. It implies that your IQ actually works against you in this phase.
It absolutely does, because it leads to very specific psychological traps. And the first one the sources outline is the moving goalpost.
Oh, I see this all the time. You hit your number, say it's $1 million, and suddenly you don't feel rich anymore because you start hanging out with people who have 5 million.
Exactly. As your wealth grows, your desires and your reference group escalate, so the definition of enough keeps drifting upward. You might have secured your financial freedom, but because the goalpost moved, you feel this intense need to take bigger, riskier bets just to maintain your new status relative to your new peers.
You're essentially chasing a ghost at that point. You're risking what you have and need for something you don't have and honestly don't need.
And that ties directly into the second trap, which is invincibility. After a string of wins, especially big ones, you start to attribute 100% of your success to your own brilliance.
You completely ignore the role of luck or timing.
Right. You think, I made money in this bull market because I'm a genius, not I made money because literally everything went up and money was cheap.
Right. A rising tide lifts all boats, but you think you're just an incredible swimmer.
Precisely. And because you discount luck, you stop assuming that bad luck is even a possibility. You stop assuming the past, like market crashes or bad economic timing, will repeat. You start to feel untouchable. And when you feel untouchable, you leverage up.
You borrow money to make more money.
Yes.
Yeah.
You take risks that can totally wipe you out because you genuinely believe you cannot fail.
There's a third trap mentioned in the sources that I found really fascinating. It's this idea of an addiction to the game.
This is a huge one for the hyper-successful. At a certain point, it's not even about the money anymore. They don't actually need another zero in their bank account. They need the dopamine rush.
The thrill of the bet.
Yes, the action. They blow up not out of financial need, but out of boredom or ego or simply a fear of becoming irrelevant. If they stop taking huge risks, they feel like they're retiring, and that terrifies them.
So they keep rolling the dice until they hit a zero, just to feel something. That is incredibly dark, but it makes so much sense when you look at some of these high-profile bankruptcies.
It is dark, but it's a very real psychological hurdle.
Well, that is a perfect transition to our next section, which is the mathematics of survival. Because when you talk about hitting a zero, that's not just a metaphor. That's the brutal math of compounding.
It is. And this is the absolute core of Morgan Housel's philosophy. Good investing isn't necessarily about making brilliant decisions every single day. It's about consistently not blowing yourself up.
Survival is greater than brilliance.
Think about compounding. We always hear it's the eighth wonder of the world, right?
Yeah.
But it only works if you stay in the game. If you have incredible returns for 5 years, I'm talking 50% a year. But in year 6, you lose everything.
Your long-term return is just zero. You're back to the starting line.
Exactly. Whereas if you just earn a boring average return, say 8 or 10%, but you do it for 50 years without ever getting wiped out, you end up with a massive fortune.
An average return sustained for decades beats a spectacular return that ends in ruin. I love that framing. So the goal is to be financially unbreakable, not return maximizing.
That is the exact shift in mindset you need.
So how do we actually balance this?
Yeah.
Because we just said you need optimism to get started, but paranoia to survive. Can a human brain actually hold both of those conflicting ideas at once?
It's difficult, but yes, it is possible. Housel calls this the barbell personality.
Break that down for us. How does the barbell work?
It means you are highly optimistic about the long-term future, but you are fiercely paranoid about the short term.
Okay, so optimism on one end of the barbell, paranoia on the other.
Right. You believe that eventually civilization advances, markets go up, and things generally get better. That's the long-term optimism. That is what keeps you invested. But you are paranoid about what can kill you in the next 12 months.
Ah, I see.
You don't assume that the good long-term result will happen to you automatically or immediately. You recognize that recessions, bear markets, and personal emergencies are going to happen.
So the internal monologue is something like, I know the stock market will be higher in 20 years, but I'm terrified it might drop 50% next week, so I need to build a fortress to survive that drop so I can actually be around to see the 20-year gains.
Precisely. You need to survive the short term to get the long term. Most people think optimism means nothing bad will ever happen. But real functional optimism is knowing that bad things will absolutely happen, but believing you will survive them to see the good things eventually.
Let's talk about what this looks like in the real world. Because staying rich sounds great in theory, but the actual day-to-day execution of it, well, the sources say it's actually kind of boring.
It is remarkably unsexy. If getting rich is a flashy, loud sports car, staying rich is basically a beige minivan with excellent safety ratings.
A beige minivan.
Yeah.
That is not what people picture when they think of wealth. So what does this beige minivan lifestyle actually involve?
First and foremost, it involves frugality. And I don't mean clipping coupons necessarily, but keeping your lifestyle costs well below what your balance sheet allows.
You're creating a margin of safety for yourself.
Yes. If you can technically afford a yacht, but you buy a reliable fishing boat instead, you have a massive margin of error. If you spend every single dime you make, you have zero margin. Literally one bad month, one unexpected expense, and you're in trouble.
And what about the actual investments? We talked earlier about swinging for the fences and concentrating to get rich. What do we do to stay rich?
You have to embrace dull allocations, broad index funds, diversification, building multiple, reliable income streams. You intentionally move away from the single hot bet that made you rich in the first place, and you spread the money out so that no single event can ever sink the ship.
But there's a massive emotional cost to this, right? The sources talk about this concept of accepting lag.
This is very hard for competitive people. If you are broadly diversified and safe, there will always, always be a part of your portfolio that is performing worse than the hot new thing.
Right.
You have to sit there and watch your neighbor get rich on some speculative crypto coin or a hot tech stock while you're just sitting in your boring index fund.
The FOMO is incredibly real.
It is. But you have to remind yourself they are playing the getting rich game. You're playing the staying rich game. You have to be okay with lagging the market or lagging your peers in the short term to ensure you survive the long term.
Okay, I want to get really tactical here. We promised you some hard rules to follow. Because relying on willpower alone to fight FOMO, it usually doesn't work. We are emotional creatures. We need a system.
We do. To operationalize this survival mindset, you need a personal rule set. Hard constraints that you decide on before you are in the heat of the moment.
And step one seems to be defining what enough actually is.
Yes. You need to establish a crystal clear threshold, a specific number or a lifestyle level where you actively say, okay, I've won. Now my goal permanently shifts from maximizing returns to protecting what I have.
And once you hit that, you implement these hard survival rules. Let's list them out. What are the absolute must-haves for this phase?
The first one, and probably the most critical, is about leverage. Debt. You need a hard rule. No leverage over X.
Why is leverage the ultimate enemy here? Because smart people use leverage all the time to juice their returns.
Because leverage is the only thing that can force a smart person to sell at the bottom. Think about it. If you buy a stock with your own cash and it drops 50%, you can just wait. You still own the shares, so you have time on your side.
Or if you bought it on margin.
If you bought it with borrowed money and it drops 50%, you get a margin call. The broker demands cash. You are forced to sell at the exact worst time. You are wiped out. Leverage fundamentally removes your ability to wait. So maybe your hard rule is, I will never borrow money to invest once I hit a net worth of X, period.
I really like that. If you can't bust, you can wait. What about concentration? We said getting rich requires concentration.
Right, but staying rich requires the exact opposite. So you set a rule. No single asset can make up more than Y% of my net worth. Maybe that's 5%, maybe it's 10%. But it mathematically prevents one bad company or one collapsed real estate deal from wiping you out.
It caps your upside, sure, but it puts an ironclad floor on your downside.
Exactly. And that brings us to the third rule, liquidity. Cash.
Cash is trash, right?
Huh.
That's what all the gurus say. Inflation just eats it.
In the getting rich phase, sure, cash is a drag on returns. But in the staying rich phase, cash is oxygen. You need a rule. Always maintain Z months of expenses in totally safe, liquid assets. Not stocks, not real estate. Cash or cash equivalents.
Because that prevents you from being forced to sell your good assets at bad prices just to pay the bills during a recession.
That's the nightmare scenario. And a big cash buffer prevents it entirely. There's one more rule the sources mention that I think is absolutely brilliant. It's a behavioral rule.
Oh, I know this one. No financial decisions driven by FOMO or envy allowed in under 24 hours.
Yes. It's a mandatory cooling off period. If you get a hot tip at a party or you see a stock soaring on social media and you feel that panic that you're missing out, you are not allowed to touch your money for 24 hours.
It's like a circuit breaker for your brain.
It really is. Usually, the urge just passes once the dopamine spikes and settles.
And all of these rules really just boil down to changing your primary metric. When you are getting rich, you look at expected return.
Yeah.
You ask, how much can I make? But when you are staying rich, you look at risk of ruin.
You start asking, what would have to happen for this decision to permanently impair my freedom?
Exactly. If the answer is, well, a 20% market drop would wipe me out, then you are way too risky.
Hmm.
If the answer is, it would take the collapse of the entire global economy to wipe me out, then you're probably safe enough.
That is the perfect way to measure it.
This brings us to the final hurdle. We have the logic, we have the math, we have the rules, but we still have to deal with our feelings. How do you emotionally accept that the boring phase is actually the winning phase?
It requires a profound reframe. You have to actively stop looking at excitement as the reward.
Because the excitement of the getting rich phase, the big deals, the risk, the huge swings, that was the prize for a long time. It feels good.
It did feel good. But in the preservation phase, the prize is freedom. The prize is autonomy. The prize is stability. You have to realize that waking up every single morning knowing you are financially unbreakable is actually a vastly better feeling than the temporary adrenaline spike of a risky bet.
It's a complete shift from prioritizing the upside to prioritizing not resetting to zero.
Yes. Staying rich means you never, ever have to sell at the bottom. It means you never have to go back to square one. It means you never have to sit down and explain to your family why the money is just gone.
And frankly, it means you don't have to impress anyone anymore.
That's a huge part of the relief. The winning move is prioritizing staying in the game over constantly trying to prove how smart you are. If you have deep psychological need to prove you're a genius every day, you will eventually take a risk that blows you up. But if you are content simply knowing that you are free, you will survive.
It really is a fascinating paradox. The most difficult financial skill isn't stock picking or analyzing macroeconomics or reading complex balance sheets. It's basic self-control. It's the sheer ability to stop the goalposts from moving.
And the quiet confidence to recognize when you've already won.
This has been such a crucial deep dive today. It's a vital reminder that the skills that got us here absolutely won't necessarily keep us here.
I couldn't agree more.
I want to leave you with a thought to mull over today. It's a question that might honestly save your financial life one day. If you have already won the game, if you have hit your number, whatever that is, why are you still playing by the rules of someone who is trying to get rich? Stop trying to win a game you've already finished.
That is the ultimate takeaway.
Thanks for joining us on this deep dive. We'll catch you next time. Stay safe out there.